The price of money changes every day, and almost no one who uses money gets a say. You might think it's set by governments, or markets, or some neutral force called the economy, but the truth is darker. The price of money is controlled by a tiny group of people using tools most of us never see, reacting to pressures they rarely admit out loud. And right now, that control is more critical than it's been in decades. Because the price of money decides who gets rich quietly, who struggles loudly, and who never even gets a chance. Let's slow down. What is the price of money? It's interest rates, how much it costs to borrow, how much you earn by saving, the invisible gravity pulling on everything, from housing to stocks to governments themselves. For decades, we were told a simple story. Central banks set interest rates to control inflation and stabilize the economy. Responsible. Technical. Boring. That story worked when rates barely moved. But today, a single rate decision can wipe trillions off markets in minutes. Mortgage payments double, governments panic, currencies collapse. So who's really in charge? On paper, it's central banks, the Federal Reserve, the European Central Bank, the Bank of England, independent institutions run by economists, protected from politics. That independence is real, but it's incomplete. Central banks don't act in a vacuum. They respond to inflation, unemployment, financial stability, and something rarely mentioned: market expectations. Markets don't wait, they anticipate. They pressure. Sometimes they corner. Here's the mechanism most people never hear about. Central banks don't directly control all interest rates. They control a very short-term rate, overnight lending between banks. Everything else, mortgages, corporate debt, government bonds, is stacked on top of that base, like a skyscraper built on a single pillar. But that pillar only works if markets believe the central bank will defend it. Belief is the real currency. If investors think inflation will stay high, they demand higher returns. Bond yields rise, borrowing gets more expensive, whether the central bank likes it or not. At that point, the bank has a choice: fight the market or follow it. History shows what happens when they fight.